have some attendees in. Hello, attendees. Thank you so much for joining us. Today we have a great speaker. I'm always excited. Each and every week we have another topic, another speaker, someone else who's had some experience in something else from a financial perspective. I'm excited about this speaker in particular because I've personally known her probably 10 years at this point. And so I have leaned on her for information kind of along the way as well. And so I'll start off just kind of read a little bit about Channing Jones. She is an accomplished leader in financial planning and education with highly valued success, leveraging training and leadership to drive organizational growth, performance, and profitability. Throughout her career, she has had far-reaching results in management strategies, planning, coaching, mentoring, with Channing leading as a change agent, orchestrating financial leadership through management decisions of organizations that have had transformative results. And that's huge. And so she's a certified master financial coach through Dave Ramsey. She coaches clients to prioritize both short and long-term benchmarks. And she started her journey in real estate with multifamily through NACA. And so I think that's huge. One, because we've had a number of conversations within the group about should you use NACA? The process is long. We had a long post a little while ago. I can't remember who brought that one up, but she was trying to determine should she start with a multifamily or should she look elsewhere in terms of her options? And so it's just a really great opportunity for us to really talk through, because there are investors who they go full-time into real estate. And I think this is a great topic. And this is why Channing is a great speaker, is because there are others of us that are doing this in conjunction to everything else. So you're working another job, maybe you have another business, whatever it is. So you don't have to make this your 100% everything and just continuously be kind of a real estate mogul. You can make this part of your passive income that comes in, provides some stability, really pads your financial independence and your financial livelihood as well. And so I want to start off with Channing. The first question I just want to ask is, what made you start with multifamilies? What kind of led you there?
Okay. Well, first of all, Rosalind, I want to thank you for the invitation. I'm always excited to talk about NACA and my journey. So thank you for the invitation. In terms of why I started with multifamilies, is because really I was looking for a way to create passive income for myself. I had just graduated college and I was making $25,000 a year. I had 4 roommates. We were living in a 3-bedroom, 1-bath house. And I needed to figure out how I could get my independence and have my own bathroom and also keep also keep the job that I love, which really didn't pay me well. Sorry to say. So that's why I started passive income.
And that's huge. I think that's many people are trying to figure out the same thing. And especially, and I'll say Channing is in Washington, D.C. Oftentimes we talk about high cost of living areas and we're like, oh my God, I could never afford X. And so if you're in a high cost of living area and you're saying, I could never afford a single family home, or I don't know if I'll be able to come up with the down payment for X, that's where NACA comes in and provides some helpful hints and resources to kind of get you along on your way. And I know, Channing, you wanted to, and of course, if you have any questions, feel free to drop those in the chat. We're going to make this as interactive as possible. I know Channing wanted to start off with some information with a PowerPoint.
Okay. First of all, I want to let you guys know that I'm a complete extrovert. So I need your participation in this, your participation, your engagement, your questions. That's going to make the dialogue a lot better and more fruitful for you. So that's what I need from you. What I'm going to deliver to you is the presentation and hopefully be of some assistance to you as you're going through the NACA process. It would also be great if you could have a calculator. We're going to be doing a little math. It's Math Monday. We're going to do a little bit of math today. So let me go ahead and share the screen with you guys. And we'll start with this. And we'll start with this because this is where I always start. I am a firm believer. I am a believer in Jesus Christ, in God and Lord as our Savior. And I do believe that in my heart of hearts, He has our life already planned and He wants us to prosper, to do well. And He wants to give us hope for the future. And that's exactly what He did for me when I started down the NACA journey. So I'm going to move to slide 2 now. Look, starting real estate journeys with your multifamily properties. Okay, before we begin, let me give you this disclaimer. I am not an accountant. I am not an attorney. I am not a certified financial planner. I'm going to be giving you my story as it relates to me, but please consider that this is specific to me in my specific financial journey at this particular time, and to please consult your professional expert in this regard. It's very important that the advice be tailored to you. So here's what I'm going to deliver today. I'm going to talk about NACA, going to give you an overview, talk about the benefits of the program. We're going to look at their steps, their home buying steps. We're going to look at that mortgage, that NACA mortgage, which really is America's best mortgage. We're going to look at multifamily opportunities and how to create passive income. We're going to talk about how to get that money to renovate that property if in fact you need to. And we're going to talk about the power of leverage. And then of course, questions and answers as we go along. So first of all, before we do that, if I could just have someone be brave enough to tell me their name, first name, and the industry that you are working in. This is where the dialogue part comes in. So if you could tell me your first name and what industry you work in. Be brave. Is there one brave?
Anybody?
Yeah, somebody.
All right, we got 2 people. So Marsha said intelligence industry, and then Renee is in the tech industry.
Okay, and Renee is in tech.
And we got Sydney in mental health. We need that.
Good.
Jennifer is in the federal government.
Mental health.
And we have Tiffany in financial services.
Tiffany. Is this my sister circle, Tiffany?
I have Tiffany Essex.
Yes.
Yeah.
Thank you for joining, Tiffany. Okay, so that gives me an idea of who's on the call and who might be able to contribute to our conversation. So as we begin talking about NACA, first I want you to know how NACA was born. NACA was actually born out of a movement. Essentially, their movement was to fight against predatory lending and to fight against discrimination as it relates to lending and borrowing. They are a non-profit organization, and their vision and mission is to build strong, healthy neighborhoods in urban and rural areas nationwide through affordable home ownership. It is a first-time home buyer program. It is an owner-occupied program, meaning that when you purchase through NACA, you are required to live in the property. And obviously, the program is designed to help low and moderate income people achieve their dreams. Now, if you take a look at all the offices there are of NACA, they're nationwide. So obviously they cover the DMV, they cover North Carolina, South Carolina. My sister in Texas, if she wants to buy, she can use it. Atlanta, Georgia, the Black Mecca, they can use it, etc. So just know that you can use it wherever you are in this country. So we're going to talk about the mortgage. Oh, it's fantastic. And as a benefit of going through this program, you have the benefit of that mortgage. You also get home ownership counseling. There's renovation assistance. They also help people stay in their homes. So if you are delinquent on your mortgage payments, NACA will help you avoid foreclosure. They really are an advocacy group. They fight for economic justice. And they've been doing that since 1988, way before it was popular to do so. So you can probably hear that I absolutely love NACA and what they do. So far, any questions or concerns about who NACA is, what they are, what they were created to do?
None yet.
Perfect. I will move forward then, assuming there are no questions. I'll move forward. So NACA has home buying steps, and there are actually 10 home buying steps. I just want to read through these steps with you. So the first thing you do in the program is you go to the home buyer workshop. In the workshop, which is 4 hours, by the way, they give you information on how the program is going to work from soup to nuts. So all the way through the process. Now, I do know that they are doing this virtually now because of COVID, but that really is the beginning of your journey. If you're interested in NACA, you must sign up for the workshop to begin with. After that, you have your counseling and they prepare you for home ownership. Then you go through the mortgage options, which is the NACA mortgage. We're going to spend a lot of time talking about that. Then you search for your home, you purchase it, and you are ready to get ready to move into your home. And then NACA comes out and inspects the property to make sure it's in good position or good condition. And you work with an underwriter to process your mortgage. You do a standard loan application. They're going to pull your credit, and that's it. The very last step is you're required or expected to be a part of NACA as a contributing member to support the organization's mission after closing. So you'll be asked to volunteer at certain events. Now, it's not a requirement, but I will tell you that sharing your story with other people who are going through this process is really beneficial and impactful. So we're going to look at
one question as you're going through the 10 steps. What's the timeline for those 10 steps? Are we talking 30 days, 60 days, 90 days?
Okay.
How long does that take?
Let me tell you, this process is not for the faint at heart. Now, it took me 1 year to get through the program. So in terms of a timeline, that's what you're looking at. And it actually could be longer than a year. So I would expect, the average time to be anywhere between 18 to 24 months.
Oh, wow.
This is not a quick process. And as the popularity of the program has grown and grown and grown, you can imagine that the wait time has even increased further because there are more people looking to do the program. So please be prepared for that wait. Please be prepared for that wait. Any other questions about that piece?
We have a question. Is this for first-time buyers only?
Yes, this is a first-time buyer program. Good questions. All right, we're moving forward. So now we're going to move to the mortgage part of it. And this is the most exciting part of NACA. As a NACA member, you qualify now for this NACA loan. And the loan is no down payment, meaning no money. You bring no down payment money to the table. You're not going to pay any closing cost on this deal. You are not going to pay any points or fees. So those are fees that the lenders, the originators use essentially to pay themselves, but you're not going to be paying those fees. Your interest rate is going to be below market. Now today, the NACA rate is 3% because mortgage rates can't get much lower than they already are. But when I went through NACA, my rate was 8.25%, believe it or not, 8.25%. Wow.
Now, what year was this, Shannon, so we can put some some context to it?
Context is good. This was 2002, okay? So way before these rates started going down. And that actually was 100 basis points or 1 full percentage point below the average average mortgage rate at that time. So that's fantastic. You do not have to have perfect credit to apply for this program. The counselor, your mortgage counselor, will help you in terms of cleaning up the credit and doing things that you need to do to get you in a position where you can move forward with the application. But you don't have to have perfect credit even to close. And the last piece here is that you get the same loan benefits as everyone else in the program. As a former lender myself, lenders like to assess the risk of a loan. And if you are potentially high risk or a high risk borrower, we'll price your loan according to the amount of risk we are taking on that deal. So you may find that with a great credit score of 800, that you're not going to pay a higher interest rate. But if your credit score is 500, you might end up paying a higher interest rate than that same borrower. Now with NACA's program, there is none of that. There is none of that. So that's really fantastic news. All right.
We have one before we move on. This is just technical. She says, can you explain a little bit about points? And so I know you said 100 basis points. And so 100 basis points definitely is what we more so say in the financial world. But Shannon, do you want to explain what basis points are?
Yes. And please interrupt me. If I start talking bankerese, please interrupt me. So thank you for the question. We're talking points in terms of the mortgage or points in terms of interest rates, Rosalind?
I think you mentioned that your rate, when you got the 8% mortgage rate, it was about 100 basis points lower than what the overall market rate was going to be. Yes. And so just to kind of equate what 100 basis points is in terms of actual kind of everyday language.
Absolutely. So at the time, mortgage rates were about in the range of 9.25% or 9.5% even. But the rate that I received on my loan was 8.25%. So as you can imagine, with that type of savings, you essentially can afford more home. You can afford more house if your interest rate is lower. Does that make sense? I hope I'm making sense.
Yes. And just to kind of go into detail about like the basis point portion, because oftentimes we'll say 100 basis points, and 100 basis points is simply 1%. Yeah. So 1 basis point is 0.01%. And then you just keep going up. But sometimes people say, oh, 50 basis points more, that's going to be 0.5% more. Right. So if we do the interchange in terms of what the basis point versus percentage points is, most people in the financial world will say basis points, but it's just an equation of how we come up with that percent.
Exactly. And forget the 100 basis points. Just know it's 1% lower. The rate that I received is 1% lower than the market rate was during that time on the average mortgage. Does that make sense?
Yes, she says she gets it.
Perfect. All right. Any other questions about basis points and all that craziness?
Not yet.
Okay, we're moving forward. So this slide talks to us about debt to income. Here we go again with this banker language, okay? DTI, or debt to income ratio, okay? This ratio is set by the bank. This is essentially the maximum percentage that the bank will allow you to have in total debts at closing. So essentially the calculation is your total income divided by your total debt. Now, the bank sets that rate. So for the purposes of our exercise today, I'm going to set the DTI, or debt to income ratio, at 50%, meaning that your total monthly payments cannot exceed more than half of your gross monthly income. Does that make sense? Any questions about debt to income?
Not yet, no.
Okay, so we're moving forward. With NACA, you can actually select these 4 property types. So you have a single family home that you can do, a duplex, which is 4 units, a triplex, which is 3 units, or a quad, which is 4 units. So you can actually, going back here, you can actually select which one you'd like to buy as part of the process. I chose the quad option, but you'll see why here in just a moment. All right, now we're getting to numbers in terms of.
And then we have one question that says, did you go through NACA process for a multifamily property first?
I absolutely did. My first home purchase at 28 years old, I was a baby, was this 4-unit property. And that's how I know there is a God, because I had no idea what I was doing. Well, I had enough idea, but there were some intricacies there that I had to learn along the way. But yes, to answer the question, the 4-unit building was my first home purchase.
And Paula wants to know what is defined as debt.
Okay.
Income.
This is a great question. Debt includes any monthly payment that you may have. So let's consider this. If you have a car loan and that car loan is the car note or car payment, however you want to carry it, is $450 a month. And then you have a student loan monthly payment, and that's $2,000 a month. So those total together would be $2,450 in debt monthly. So we would take that number, well, actually we'd take your income and divide it by that number. That's where we get the debt to income ratio. Am I making any sense? I think I need Sydney with some mental health assistance at this point.
Sydney said that's so inspiring. Thank you. She's 26 and she's going through NACA now, and she was trying to decide if she should do a multifamily as her first home.
Oh, so, yeah.
Sydney, you were right there kind of in line with Shannon and her timeline as well.
Oh, Sydney, you have to do it. Now, again, I will go back to my disclaimer. I'm not an accountant. I'm not a lawyer. My recommendation, my strong recommendation is you continue forward with that. So any questions, any more questions about debt to income ratio?
She says, is credit included? Paula, I'm not entirely sure. I think you're just wondering is, she's saying, or subscriptions, utilities, etc., credit cards, those kind of things. I'm guessing this is further on the debt to income piece.
Right. Great question. The only thing that is included as a monthly payment is anything that would show up on your credit report. So your student loans, your installment loans like auto loans, personal loans, your credit cards, they're certainly going to show up as payments on your credit report. But utilities, your cell phone, your power bill, none of that is reported on your credit report. So that is not included.
And then Tiffany says, do you have to be a first-time home buyer overall or just in the state in which you're looking to purchase the property?
Okay. That's a sidebar conversation that I would really love to have with you, Tiffany. Please give me a call. You'll see my contact information at the end of the presentation. But the straight answer with that is you need to be a first-time home buyer in the state. A first-time home buyer, period. So if you bought your first home in Virginia and now you have another home in Florida, you will not qualify for the program as it stands using that cut and dry explanation. That being said, Tiffany, I would like you to reach out to me at the end of the presentation so we can talk about that a little bit more. And anyone who has any other questions about that first-time home buyer piece, please reach out to me directly. What other questions are out there, Rosalind?
That's all we got at the moment. So
okay.
We'll keep pressing through.
We'll keep moving. Okay, so going back to that debt to income ratio, there are only 2 factors that you can control on that debt to income ratio, right? You can control the amount of money that you make. So more money is going to mean more home or more house that you can afford. And the less debt you have, the more house you can afford. So your two wiggle factors in this are either increase your income or lower your debt. And if you can do a combination of the both, that would be fantastic. Let me stop right there. What questions are there about the two wiggle factors or what you can do to afford more house, quote unquote?
So we don't have anything on that one. We do have a question. It says, how long do you have to live in the property?
Okay. Forever. Well, maybe I shouldn't say that. If you are on a NACA loan, then the expectation is that you are in the home. I would love to talk about this with you further. So please give me a call, whoever asked that question, at the phone number at the end of the presentation. But to be cut and dry, they would like you to live in the home. Rosalind, is there something else I can clarify about that, you think?
Allison, I know you asked that. Did you want any other information there? Nope, I don't see anything.
Yeah, the whole purpose of NACA is it's a neighborhood stabilization program. So NACA wants you to buy this home and then become part of that community and stabilize that community, if that makes any sense. So that's the philosophy behind NACA. Now, I eventually refinanced out of my NACA loan. And when I did that, I was no longer beholden to the requirements of the NACA loan. I hope that makes sense.
Now tell us, what would the benefit be in refinancing out of the NACA loan?
Okay, so one of the NACA things says that, hey, you've got to live in this property, right? We want you to stay in this property and stay in the community. If I no longer have a NACA loan, I'm not bound by that restriction. Or the volunteering piece. We would like you to volunteer for NACA. It's not a big volunteer requirement, but they want you to volunteer. And it's, not something that is time consuming, but they want you to volunteer. So if you refinance out of that, then you no longer have to volunteer. Now, I think you should volunteer because the program is fantastic, but you're no longer beholden to that. There's also a small monthly fee to NACA that is paid on a monthly basis to support the program. Mine was $50 a month. And so that money then goes right back into the operating costs of the nonprofit and helps the nonprofit continue operating business. Does that make sense? Any other questions about that?
Nope, not yet.
Okay, just the end of the, really, when the chips are down, you need to think about whether or not you want the property that you are in, that you bought through NACA, to continue to be your primary residence or not. If you want it to become some other type of property, like an investment property, you should not have a NACA loan on that property. Does that make sense? Oh, Lord, I hope it does. Okay, I'm going to show you this. There is a lot of math on this. Do not let the math fool you. In fact, everybody just close their laptop right now. Don't even look at the numbers. Don't even look at the numbers. No, I'm kidding. We are going to look at passive income and how you actually build passive income. So you remember we had 4 types of properties that you could buy. You can buy a single family home. You can buy a duplex, which is 2 units, a triplex, which is 3 units, or a quad, which is 4 units. Now, let's assume you go with the single family option. Okay, that's this option here. And you make $24,000 a year, which gives you a gross monthly income of $2,000. Gross, of course, is before taxes are taken out of your money. All right. Now, based on this gross monthly income, your mortgage payments and any other debts cannot exceed $1,000 a month. Now, that is assuming a 50% debt to income ratio. Have I lost you? Somebody say amen if I have lost you.
Looks like everybody's on board. Everybody got it?
Let me just repeat that debt to income ratio of 50% says, hey, no more than half of your income can go toward all of your debts that are listed on your credit report or any future debt that we are trying to underwrite for you. Okay. In this example, you have no passive income. Why? Well, because you're the only one up in there. You're the only person in that single family home. No one is paying you rent. Therefore, when you look at passive income, you don't have any. Your tenant's not paying anything. And that's it. $1,000 is your monthly payment, your adjusted monthly payment. And so the amount of house you can borrow is up to $109,000 based on these numbers. So we're talking about $24,000 a year at a debt to income ratio of 50% or half of your monthly income. And then what I did was I backed into the market value of the home that you should purchase, or that you will, the maximum market value of the home that you'll be purchasing. And that maximum actually includes your principal, your interest, your taxes, and an insurance all in one payment. Now, I know I have gone too far. So please, someone ask me a question, because I feel like this is coming so fast.
Well, Paula says, what is a favorable debt to income? And so I know you have the 50 there, but what would be favorable?
Okay, is that Paula?
Yes.
Okay, Paula. The debt to income ratio is set by the bank, so they determine what's favorable. Now, I worked for a very conservative bank, and so our debt to income max was 40%. The bank did not want you to exceed 40%, and that 40% included the loan that you were applying for, the new payment. So I hope that makes sense. Each bank sets their own. The more conservative the bank, the lower the debt to income ratio is going to be. And at some point, it's going to tap out. Like, no bank is going to let you use 100% of your income to go toward your monthly payments. You still have to eat, right? You need gas for your car, you need a cell phone, all those things. So just be aware that no bank's going to do that. Rosalind, help me. Did I explain that properly?
Yes. And it's really even to your advantage, because especially when we think back on 2008 and 2009, and we were going through the mortgage crisis, oftentimes people were kind of so far underwater and so stretched thin in terms of their overall monthly expenses, is because people would do things to manipulate their debt to income, or they would do stated income loans so that they can state an income high enough to get the mortgage payment that they need. So oftentimes, I know as we're looking through some of these numbers, people say, well, goodness, why does it only have to be 40 or 50 or whatever that number might be? That can actually be a protection for you in the long run. So it's actually a positive thing to have a limit in terms of what the bank would allow you to commit to in terms of a month-to-month mortgage payment.
Thank you. That's a great point. And as a former lender myself, if that ratio of 40% at the bank I was working at was exceeded, then my recommendation had to be for the overall financial fitness of that individual to not proceed. First of all, we couldn't approve them anyway if it was over 40%, but I helped the borrower understand why they shouldn't at that particular time and the things that they could do to improve that ratio. Remember, we have those two wiggle room items, increasing the income or lowering the debt. Those are the two factors that you can control. And if you do that, or both, then you can make your debt to income number better, lower. Okay.
Another question. It says, does the debt to income ratio always include the home monthly mortgage?
Yes. Now, I assume what this individual may be asking is, does it include principal, interest, taxes, and insurance on your mortgage payment? So let me explain that. In your mortgage payment, you're paying the principal and interest on the loan that you are borrowing. You're paying taxes, your homeowner taxes, your county's homeowner taxes at whatever rate they determine, and you're paying your insurance. So your taxes and your insurance monthly payments go into an escrow account, which is being held to the side, so that when that money comes due, it's paid from that account. Does that make sense? So when we're looking at debt to income, your lender, when they underwrite your loan, they're going to do a calculation that includes principal, interest, taxes, and insurance, all of those numbers combined. Okay. Any questions about that?
Nothing yet.
Okay. Are y'all still there? Y'all remember I'm an extrovert, right?
Nope, we got a confirmation. She says, yes, that explains it.
Okay. So now let's look at the duplex. I really want you, what I really want you to look at are trends. Trends. We're not looking at specific numbers, we're looking at trends. So if you notice on the duplex, I'm renting my unit out for $1,100. I'm living in the other unit. If my tenant pays me $1,100, I have $100 a month in passive income. So essentially that extra $100 a month is wiggle room. But what NACA does is extraordinary. Okay, this is where it gets fantastic. Instead of qualifying you based on this $2,000, which is your W-2 income, NACA will actually qualify you using your rental income that you haven't actually received yet. And this is why NACA is so great. They will allow you to consider income that you have yet to receive as part of your loan. Let me repeat that in a different way. If you go to a car dealership and you say to them, hey, I want a loan. And they say, okay, great. Give us the name of your employer and your two most recent pay stubs. You're like, oh no, I don't have a job. I don't have a job. And, I don't have a job. I don't have two pay stubs. So they're going to look at you and say, what? You want a car, but you have no source of income. Well, and then you go back to them and say, yeah, but I'm going to have a job in a month from now. That's still not going to fly with that lender, correct? Because the lender is saying, look, you haven't made that money yet. We can't include that to underwrite the loan. But NACA is different. This is the beauty of NACA, and I need y'all to hold on to this. That future income, that $1,100, is now added to your gross monthly income, W-2 income, which gives us a new monthly payment of $3,100. So this is your new monthly payment. So we're adding the tenant's money that they give you, and we're adding your W income money together. And now you have, instead of $2,000 a month, you're being qualified on, you're being qualified on $3,100 a month. This is fantastic. So now if I'm taking 50% of this number, my maximum payments should not exceed $1,550. Well, that's a lot different than should not exceeding $1,000. Okay, let me stop right there. So the trend is this: the more money you have, remember the two wiggle room factors we have. The more money you make, the more house you can afford. The less debt you have, the more house you can afford. So if you look at this, we see that on a duplex, using the NACA additional rental income, I can afford more house. Look at that. I jumped up from 109 to 239. So now instead of shopping for a home that's $109,000, now I can shop for a home that's $239,000. This is the beauty of NACA. Let me stop right there. What questions do you have as it relates to that? Tiffany, I'm using your "what questions do you have" question. Tiffany is a corporate trainer and she never asks, do you have a question? She always assumes that you do and says, what questions do you have? So Tiff, thank you for that. Okay, I'm moving on because I'm hearing no questions.
They're coming, I'm sure.
Okay, they're coming. Okay, so now let's go to the triplex option. Remember, your tenant is paying you what? $1,100 a month. Well, now you have two of them. Now you have two tenants. So you're now making passive income of $1,200. That's what you're bringing in because you have two tenants. And not only that, you're living rent-free or you're living mortgage-free. So your tenants are paying your mortgage and you're also making $1,200 a month. Now, keep in mind, you still have this W-2 income, which is what I tell folks. I say, listen, never leave your day job until you are ready to make that move. If you leave your day job, so if you get rid of this number here, now you have less passive income and you're really, you're doing yourself a disservice now. So if you were to completely get rid of this W-2 income, you're not helping yourself out there. Keep your day job is my point. Okay, so let's go back to the triplex option. So now we're making $1,200 a month in passive income. And remember our payments, right? We have, I'm trying to go back to this here. So we have new monthly income, including your rental income, as $4,200. That means your $2,200 in passive income from your tenants and $1,000 from your W-2 income every month. Is everybody there with me?
Looks like everybody's following.
Okay, let's keep it moving then. So now this number is what your income is based on, or what underwriting will use as your income number. And so now you can withstand a $2,100 maximum monthly payments of any allowed debt, which actually is a home of $370,000. So this number is assuming you have no other debt besides your mortgage debt. If this number, if you have mortgage, a car loan or a student loan or something like that, this number is going to go down. That's why you don't want to quit your day job, because you don't want to lose that income, and you want to have as little debt as possible. The higher the debt, the lower your adjusted payment is going to be. Okay. Now, let's look at the quad. This is the option I chose. Right? So actually, this is a real live scenario, because when I purchased the quad, I made $24,000 a year. And so what I qualified was, using a ratio of 50%, I qualified for $1,000 a month payment, which would be a home of $109,000. Now, I can get a home of $500,000 if I have 3 tenants paying me $1,100 a month. Because look, I'm bringing in $3,300 in rental income. And I also have my W-2 income of $2,000. So now my new monthly income, including my future rents, is $5,300. Now, if I take half of that $5,300, this is the maximum monthly debt that you can have. And this would include any debt, car loan, student loan, whatever. And the new mortgage loan that you need that you're looking to buy. And now you can buy up to $500,000 in home. And take a look at this number. Now I have passive income of $2,300 every single month. My passive income now exceeds my W-2 income. So technically I could quit my job. That being said, that would not be a good idea, because if I took that $2,000 away from my monthly income, then I'm really going to be stretching myself.
And Shannon, I'll just jump in here, because as we're kind of going through these numbers, and so many of us are talking about, can we retire early, or if you're in a high cost of living area. So if you're in a high cost of living area, you would look at the 109 and say, there is nothing in my city that's $109,000. That's definitely true for DC. There's very few places that you're going to find $409,000. But as you start going further up, people are like, there's no way I can afford this mortgage payment. And this is a great calculation just to say, okay, understand, in DC, I think parking spaces are sold for like $30,000, $40,000. So we're barely able to buy anything in DC for the 109. But as we start to get a larger budget, then once again, it's a payment that might be outside of our abilities in terms of what we bring home every month. So this is just a great calculator just to show you that. But then, as Shannon talked about, of like not quitting your day job, as you make this a part of your plan, and so many of us are saying we want to retire early, creating that passive income that maybe if you wanted to step back from working, if you wanted to take a break, if you're going to retire, if you had some other assets, or once the house is paid down, you can refinance, have a lower payment, those kind of things. It just creates some flexibility and some wiggle room. So that's why these numbers are just so powerful.
Absolutely. And the point that you make about market value, the reason that you're able to get this larger home, or a home that is worth more, is because of the money your tenants are paying. I mean, it's just that simple. If you didn't have this extra $3,300 coming in a month's time, you could not afford the payment on this house. But you're living free, you're living rent free, and your tenants are paying in the other 3 units. So you have $2,300 a month of passive income that you can do whatever you want to do with. Going back to Rosalind's point, you can invest it. You can buy other properties. You can increase the contributions that you're making to your 401k. There are a myriad of things. You can fund your children's college funds in a quicker amount of time.
And Shannon, just to say what you said one more time, because I want to make sure everyone hears this. you're not paying rent anymore.
Right, that's the part.
That's huge. I think we kind of glossed over that is you are no longer paying any type of rent. And so just looking at this numbers, this is someone that's only making $24,000 a year. So you're making $24,000 a year. And let's say you were paying $1,000 rent. Heck, depending on where you live, if you live where I live, you might be paying $1,400, $1,500, $1,600 in rent, and that goes away. And so I think that is huge to be able to see, because I think sometimes we focus, and oftentimes people are talking about the amount of debt that you have. I am less focused on the amount of debt that you have and more on your cash flow, because month by month is how you live. And if your debt, so if this $500,000, and I remember when I bought my multifamily, I was like, oh my God, like this is a lot of money. If you're in a situation where the cash flow works out,
right,
this is never really a debt that you actually service. And so when we talk about servicing your debt, it's basically your income paying off the debt. If you're not servicing the debt and your tenants are, that number shouldn't be as big or as scary. I know in my case, I was like, "Ooh, that's a lot of money." But just having someone else to pay it off makes a huge difference.
Yeah, so consider with this passive income money, your mortgage, you have no monthly living expense. The biggest living expense you will have is your rent or mortgage payment. So imagine eliminating that and then also having some icing on top of the cake. Questions? Questions? Okay. Well, I'm going to assume that that makes sense to everybody, and I'm going to keep rolling. I already had that. Okay, so now that we know our monthly payment and how much house we can afford, now we're going house hunting. Y'all know that show, House Hunting? I love that show. So with NACA, you're going to be working with a NACA approved lender. And there are specific, I'm sorry, a NACA approved realtor. That should say realtor. Well, you're going to be working with a NACA approved lender too. But if we're talking about house hunting, we're talking about realtors. So the realtor is actually going to use a traditional MLS system that everyone uses to list their home, and they're going to find you a home that is within that market value that you qualify for. So going back to the old scenario of the quad that we just looked at, they're going to look at, I have a quad, or I want to buy a quad. I make $24,000 a year, and I have $3,300 a month in rental income. So I can afford a $500,000 home. So they're going to look at properties that fall within that range. They're not going to show you houses that are $1 million. They're going to show you homes that are within that pre-qualification amount, because that is the amount of house you can afford. So as you're looking at homes, you're going to consider the location of the property. And actually, you're going to be looking for that perfect home or that perfect investment. In my case, it was the 4-unit property, because I wanted the rental income. I wanted to live mortgage free. And that was the perfect property for me. The property that I found was actually 2 blocks from the metro. That was also very important to me, because I knew over time that the value of that property would increase because of the proximity to the metro. I also knew that the traditional Capitol Hill at the time was eventually going to push farther toward RFK Stadium, which is where I live, and that eventually it would be considered Capitol Hill too. And that's what happened. I am now in an area that's considered Capitol Hill East. So I'm not in Capitol Hill, but I'm in Capitol Hill East. Okay, so that's wonderful. Any questions about the location, and the location? All right, so you're going to be working with a realtor. You're going to do your due diligence around the realtor, and you're going to be doing your due diligence around the property. Now, this question here, how bad do you want it, really goes back to the timeline question that Rosalind was talking about earlier. With NACA, you're really looking at a minimum, a 12-month process. And really, it's about how bad you want it. So in my mind, I say, well, gosh, they're really testing me to see if I really want to do this, you know? And gosh darn it, I am just bound and determined to do this because this is what I want to do. And I'm not going to let anything stop me from doing that. And there are definitely going to be lots of bumps and bruises along the way. But if you stay determined, if you expect the unexpected, particularly at the last minute, something always comes up at the last minute, then you'll have the right frame of mind to go through the process in a positive way. All right, we're moving on. So after we found the perfect property, we're going to go to settlement. And then guess what? We need to renovate this house. We may not. In my experience, I actually needed to renovate the property. And I will tell you, the property was in shambles. The roof was literally falling in. Literally, I could see the outside of the roof of this property. And I knew, first of all, I knew I couldn't live in those conditions. That's number one. And then number two, I was like, if I'm going to make my rental spaces attract the type of renter or the type of tenant I want, then it's going to have some bells and whistles that the current apartment didn't have. So NACA has another great program. NACA will allow you to borrow the funds that you need to do the renovation. Can I get an amen?
That's big.
Now, let me explain why this is so huge. Okay. So in my particular experience, I bought the 4-unit, and believe me, this was 2002, and I don't want anyone throwing tomatoes at my face, but the property I bought it for $110,000. Isn't that crazy? The entire 4-unit building. That is crazy. And then I ended up putting more money into the building than it was worth. Okay. Why did I do that? Well, because the house was in shambles. And I needed to make some improvements. So here's the property I purchased. It was $110,000. The cost of my renovation was $150,000. So my total mortgage, which included the renovation, was $260,000. And I actually closed on a single loan for $260,000. It was all rolled up together. Then NACA took this $150,000 and they set it to the side. And they said, we're going to put this money into an escrow account, which will allow us to pay your contractor over time while your renovations are going on. So I'm not coming out of my pocket with any money. And NACA allows you to do a 6-month deferral of your payments while the improvement is going on. So you're not even making a mortgage payment until, in theory, the property is completely renovated, if it only takes 6 months for your contractor to renovate the property. So let me stop right there. Does it make sense that I borrowed on this one lump sum loan? Because my purchase price was this and my renovation costs were this. So now my total mortgage is $260,000. That kind of makes sense, right? Now let's talk for a moment about appreciation. After I have done all of my improvements, now the value of my 4-unit building has gone up, which is fantastic. So now it's been appraised at 335 and my purchase price was 260. So I have some equity right now in that property. Now, one might say, okay, well, how come you only have $41,000 in equity? Shouldn't you have more? Because I'm doing the math between this, and that's not $41,000. Just remember, your lender is not going to allow you to borrow 100% of the market value of that property. Most lenders will do 80%. Sometimes you can find 90%. Actually, 90% has been the go-to here recently. But it used to be 80% from a more conservative standpoint. So if you actually look at this number and you take a look at your mortgage balance and you say, okay, my lender is going to allow me to borrow up to this dollar amount, that's why I get this amount of equity. Somebody help me. What questions do you have about this?
I think this goes back. I know I asked the question, what would be the benefit of refinancing? But to refinance and pull that $40,000 out, especially, I mean, if you're going back to the very beginning, if you're there making that $24,000 and you just got into this $500,000 property, you've really come out of pocket very little. And so if you hold on to this property for 6-7 months with that passive income, you're able to build up some additional funds. And then all of a sudden you refinance and cash out, refinance and get that 40,000. Now you have something to get you to the next property. Right. So it's just a way for you to find opportunity. And everybody's at different points in terms of their income, the amount of money that's saved. And so if you don't have a lot of money saved, or if you don't want to use a lot of money, then time might be of the essence. So then you can, of course, say, I can devote X number of time to make sure that you don't have to come out of pocket, to make sure that you can actually do everything within kind of the NACA guidelines. Right. But if you don't have the time, there are other options out there as well. Because I'll say I actually did a multifamily myself. I didn't do it through NACA. So there are other options. So these numbers can work regardless of the lending solution that you actually use as well.
Mm-hmm. It's a good point. Very good point. So if we look at going back to Rosalind's discussion about funding your renovation, that $41,000 in equity now, I'm sorry, let me go back to the other number, which is the $150,000 that I have set aside for my improvements is now what's going to fund my renovation. I already talked about the 6-month deferment while your renovation is happening. Obviously, you're going to choose a licensed, bonded, and insured general contractor. NACA is going to have to approve the scope of your work. Okay. So in other words, this is what I want to do to this property. And NACA is going to say yes or no. The renovation costs, that $150,000 I mentioned earlier, actually sits in a separate account, and the contractor gets paid from that separate account, from that escrow account, after NACA has inspected the work and has approved the draw, what's called the draw from the $150,000.
And Shannon, we have a question in terms of, would you spend the same amount to do the renovation if you could do it all over again? So would you spend that same $150,000?
Heck yeah, I absolutely would. And let me tell you why. I took that property that was completely dilapidated. And I took that property down to the studs. I essentially pulled everything out of these apartments, everything. And I put it back in. I did it based on the design I wanted. I had the kitchens and countertops and bathrooms and recessed lights and all that stuff based on what I wanted. Because this was going to be my primary residence. So I wanted a nice space to live in. So yes, I think the renovation costs were well worth it.
And I'll say this, I'll just kind of jump in and I'll reiterate it. And I say it a few times. Oftentimes we look at the number itself. So we say, oh my God, $500,000. Oh my God, $150,000, whatever it is. But we are not looking at the cash flow. And so I love the spreadsheet that you provided, Shannon, because it shows you truly the cash flow. Oftentimes we're like, no, I'm not doing $150,000 in renovations because it's $150,000. But if it cash flows, and
Right.
you're making, and you're going to get the quality of tenants that you want, you're going to get that rent on an ongoing basis. It's going to pay for your mortgage. It's going to pay for the renovation cost itself. We can't always just kind of be shell shocked about the number itself and say, oh my goodness, I could never, sign my name to say I'll pay back this extra $150,000. It's definitely very different. All debt is not the same. I know we were talking about like student loan debt and so forth. Well, student loan debt, you have to work a job in order to pay back the student loan debt. This debt, you just have to sit and collect rent in order to pay off this. Very different.
Very
And so when we talk about debt, not all debt is the same, but definitely as you look at kind of the cash flow of it all to see if the numbers make sense.
Absolutely. Absolutely. So just keep in mind that everything you do, even though you're talking about these big numbers, every payment that you make is going to be offset with your rental income. And that goes back to these numbers here. Your positive cash flow numbers. Where are they? Here, passive income. Actually, it's this number because the passive income is the income that you're making after the tenant pays. But this is the amount of passive income that you are generating. So yeah, I would in a heartbeat sign that loan for $150,000 more. And it allowed me to attract a certain type of tenant that had the expectation of these things in their home. They, wanted central air and heat. They wanted a washer and dryer in their apartment. They wanted granite countertops and things of that nature. And so now all of a sudden I'm in a different tenant atmosphere than I am if maybe my property didn't have those things. I hope that makes sense. I'm moving on. First of all, we have a lot more slides to get to, but it's been about an hour. So Rosalind, I want to see if we want to hold it here and stop with any more questions, or should we keep going with helpful hints for tenants and all this other stuff? So do we need to do a part 2 or should we keep it moving?
Let's see, because we're right at 8, but I think it might be helpful to do a part 2 where we can just talk about tenants and having a tenant and so forth, because I think these numbers, just getting through the finance part itself is a lot to digest.
It is.
And I want to make sure that people understand that NACA is a way to do it. It is not the only way to do it, but the numbers still make sense regardless. I do have a question from Crystal. She says she's a realtor with Keller Williams. Her question specifically about using NACA in DC. She said she understands that it's harder to use because it takes longer to get to the closing table and longer for the sellers to get paid. She's known sellers to overlook buyers due to the process. So do you have a strategy to overcome this particular setback for buyers, especially in DC?
That is so tough because the realtor that sold me my home, he was a NACA approved realtor. Now, to her point, you can use any old realtor you want. That being said, the traditional realtors don't want to work with you because they know the NACA process is a nightmare from their standpoint. So in terms of what you can do, my advice there would be to, if at all possible, when at all possible, use a NACA approved realtor because they are familiar with the timeline. They do not have an expectation that they're going to be paid within 30 to 60 days. They know it's going to take a year. So my only advice there would be to use a NACA realtor.
And Crystal, the realtor that Shannon's talking about is actually my realtor that I met through her. I'd be happy to make that connection as well. He's in DC and definitely can kind of probably give you some strategies from the realtor side. So if you just drop me a message, I'll throw his contact information in, and he can probably kind of give you some tips and so forth in terms of how he's making it work for his clients. Because definitely from a realtor standpoint, as you're doing those negotiations with the seller and so forth, I know that might be difficult, but I'd be happy to share his information because he'd probably be able to give more in terms of what are realtors doing to help their NACA clients get to the closing table.
And I will say this, I have purchased, I don't know, 1, 2, 3, 4 homes with Donnell Kearney, and he has been fantastic. There's no way I would buy another property, any property without him. So you can reach out to me or Rosalind to make that introduction.
And I have a question from Nicole. She talks about what other options are available for this scenario without using NACA. I'll answer from my perspective because I didn't use NACA. I was not a first-time home buyer when I purchased my my multifamily. I actually owned another. And so one thing I want you to be aware of, there are other programs. I'll tell you what I use. I just simply use FHA, which is basically easy enough for everybody. You will have to come to the table with a little more money than, of course, if you were using NACA. But I still didn't come to the table as much as kind of the 20%. And so once again, I always look cash flow. So I wanted to keep as much cash on hand and available. I also rolled my renovation cost in. I want to say it was a 203K loan under the FHA umbrella. And so it was kind of the same, much of what Shannon talked about, that same kind of controlled disbursement process and so forth as well. It's just not going to be the 0% down. My rate was favorable, but it was based on, my basic debt to income and so forth. But they were also able to take into account the current, because I actually bought my building and there were tenants in it. So we were able to get the current leases and so forth and use that to count towards the current income of what I would be able to be qualified for as well. So there are other options. But if you're thinking about, goodness, do I want to start with a multifamily or not? The multifamily definitely gives you a lot of flexibility. It creates cash flow. It might actually loosen up your month-to-month living expenses as well. So all of those things are just a reason to consider a multifamily as you're looking at what might be your next property.
Which y'all love having Rosalind on this call because she just adds so much value. Thank you, Rosalind.
And one more question talks about, did I have to live in the building? Yes, because it was owner occupied. Okay. Owner occupied financing is typically going to be much more favorable than investment financing. And so, yes, I also did live in the building, but it's definitely different than like Shannon's situation where she needs to kind of finance out to leave. But my situation wasn't quite the same. I can definitely decide to stay or not. But they're expecting that at the time of closing, your expectation is, of course, to move in.
Right, that's your intent, basically.
Any other questions?
What other questions are there? You guys are so quiet. Well, let me just fast forward through some of these helpful hints with in dealing with tenants, but we'll make sure that you have this presentation so you can look through these helpful hints. One of the things I wanted to point to are, my contact information. One of the things is my contact information. So this is who I am, my personal email, my LinkedIn profile. This is my first business, which manages the property that I own. This is where's my second business? Now, this is the nonprofit arm of my financial literacy business. So this is for kids, K through 12. And then I have a one-on-one personal coaching, budgeting. Think of me like a financial fitness coach or physical trainer there, where I help you with budgeting and help you stay on budget. But that's a sidebar. I just wanted to let everyone know how they could reach me in the event that they want to reach me or need to reach me. Okay. I don't know if we have any other questions, but I'm gonna stop sharing my screen. I really hope this makes sense. There was a lot of information. Oh my gosh.
And good information. The best part I'll say is a spreadsheet. I love a good spreadsheet. I mean that's the nerd probably in me. I love a nice spreadsheet and show me the numbers and plug and play and so forth. So that's definitely my thing. But I think it just shows that it's an option. I will say probably the biggest thing when people start with multifamilies is the numbers get bigger.
Oh yeah.
Never in my life, as I was sitting there and I'm having the conversation with my realtor and I'm saying, oh, well, I wasn't going to spend that much. Right. And so you have to look at from a cash flow perspective, will it make sense from a cash flow and not simply just pure debt? So I always want to kind of remind you of that, we're looking from a cash flow, especially if you are looking to fire. So if you're looking to be financially independent and retire early, the debt that you hold doesn't matter as much as the cash flow that you bring in, because you could retire with this debt still sitting there. So if you retire and you still have the $200,000 in mortgage debt, but your tenants are still paying the mortgage and you're still living for free, you really only have to fund your groceries, your utilities, those kind of things, opposed to actually funding your living expenses. And so like Shannon said, you can use that extra money to stock away more money in your retirement or in your savings or paying off other debt, those kind of things. So it really just provides you the flexibility that didn't exist there before. And that's what we really want to make sure, that you have those options and understanding of what else you could do.
There is one more thing I wanted to add. Over time, your mortgage payment is going to stay the same unless you pull additional cash out of the property. Yes. But what will be increasing are your rents. So when I started renting out the apartments at $1,100, now they're at $2 each. So that increases my cash flow. And I have 8 of them now instead of only 4. Now, I'm not trying to toot my own horn here, but I am trying to tell you that this is something that is achievable and that you can actually do yourself. You can do this. You can do this. And oh, by the way, did I tell you, right now I'm not working. I'm chilling. I'm chilling.
That is financially independent. That is it. That is if you want to take a break. That is if, the world is on fire and you decide you don't want to go back to work for a moment. That is if you want to pursue a passion project. And so, like I said, I met Shannon a number of years ago. And I mean, I talk to people all the time. My background is financial planning. My initial career when I got started in the financial world was wealth management. And I love to hear people's story. And so unfortunately, the wealthy understand the value of strategic credit and cash flow management. Right. Unfortunately, people who aren't wealthy, they focus on the debt that they hold. And can they just make more money? Can they just pay off their debt? But really and truly, nothing matters if you are servicing debt with money that isn't actually yours. Right. And so she is paying a mortgage that she hasn't actually paid. And so that is the beauty, that is the gift in it, that is the independence of it all. Because in reality, once she takes that payment of whatever it was, and where she was paying the mortgage off $1,100 per tenant, and now you have $2,000 per tenant. Even if you lose a tenant for a month or two, who cares? Mortgage is still paid. So really want to make sure that people.
I'm knocking on wood though, because I still don't to lose anyone. Somebody has a question about tenants that are not paying. All right.
Do you have any non-paying tenants at the moment?
No. I will tell you, this is a distinct possibility. And when and if that happens, you need to be building every single month cash reserves. So every single month, as you're pulling in this positive cash flow, you need to be building cash reserves for maintenance and upkeep. I mean, you can't just had this property and leave it like this forever, there's going to be things that you're going to need to invest into the property. So maintenance and upkeep, those times when you may have a tenant who does not pay, but Lord, I'm knocking on wood. I have my vacancy rate. I've been able to turn a unit in 3 hours. So
I did it in 12. So yeah, I
have a very low vacancy rate. Oh, and keep this in mind too. Remember we talked about the market value after you did the renovation? And we talked about how the house appraised for 335 or something on the example that I gave. Well, I feel like I'm tooting my own horn here, Rosalind, and
you got to share with us. We need to hear it.
Okay. My home today, if I had to sell it, would probably be in the 1.1, 1.2 range. And that's one of the 4-unit buildings. I have 2.
That she paid, remember in the beginning, $260 all in. So somebody was hesitant. I mean, I know somebody talked about the $150,000 and they were like, oh my goodness. Well, $150,000 got her to $1 million valuation just a few years later. So we got to understand kind of the way it all meshes together, and make sure that we're understanding the value of cash flow, the value of what are you going to invest your money in, and then the return that's possible as well. These numbers are not accurate in every single market. Shannon and I both live in Washington, D.C. So when we talk about high cost of living areas, DC is definitely one of them. If you're in a lower cost of living area, you can still run the same numbers. Your rents might not be $2,000. They might be $600, but then you might be able to get into that building for $80,000 or $90,000. Right. So you can still use that same spreadsheet to kind of get there. You got a couple more questions. Renee says, do you find your vacancy rate is low because of the location? And then how do you find good locations for a multifamily?
Well, working with a great agent, a real estate agent, is really the key there. When I came across my first 4-unit, it was not in a great area, y'all. It was in the hood. It was in the hood. And it was in an area where people said, oh, you're going to live over there? And I knew, or at least I suspected, that over time, things would improve and there would be more things coming in, better infrastructure, blah, blah, blah. And so that's how I found interest in the property that I selected. Did I answer that question? Did I answer the totality of that question?
Did you find that it was a good location for, and she said, how do you find a good location for multifamily? And that, I mean, it's really, I would say, it's never good to try and do everything yourself. Lean on experts. Like I said, we both use the same realtor. And I will say, when I moved into my place, I remember when I met him. So I drive up and I was like, oh, and he says, trust me, I wouldn't put you anywhere I wouldn't put my sister. And I'm like, I don't trust you because this, I gotta hold my purse tight and, keep the gun in my hand. But honestly, I mean, like Shannon said, I purchased 5 years ago and I'm up almost $500,000. And so, I mean,
in market value?
Yes, in market value. And so, I mean, that's huge in terms of, you got to trust somebody. You need to be with somebody who kind of understands the market, understand where things are moving, understand where people are moving, where people are gravitating. This is not my day job. But if I'm going to pay somebody, I want to pay somebody who it is their day job, and they are putting forth the energy and effort and understanding the market in which you stand. So, I mean, I was in DC. I understood, what was a good neighborhood in DC. And I understood that a good neighborhood in DC could easily be 7 figures, and
easily
7 figures made my heart stop a little bit. So when we're talking from an investment perspective, you got to know somebody who knows where the market is and where it's going as well. Renee says, was the area up and coming when you bought?
Yes.
Me too. Clearly.
Yes, it was the hood. Was that Renee again?
Renee, yeah. And then Sydney says, how did you figure out that your area would be up and coming? And I'll say, I just trusted my realtor. I mean, he said it and I was like, I don't know, but okay.
I would have to completely agree with that. And I also knew that the tie to the metro, with it being 2 blocks away from the metro, that over time, that would be something that would not change. And I knew that that was a draw in the city.
And that goes back to location.
So really just have a qualified advisor helping you. You can't do this alone.
Let's see. Paula says, do you recommend using a NACA realtor to find a property, or any realtor?
I think that's a personal preference. I used a NACA realtor to do my closing. On the second property, though, I did not buy that through NACA. That was considered an investment property. And at that point, the realtor that I used for NACA actually had grown his business to the point where he was really no longer working with NACA clients, if that makes any sense. So did I answer that question?
Yep, I think so.
Oh, yeah.
So let's, one, do we have any other questions?
Yes.
As you're typing in your other questions, I'll let Shannon do her closing remarks. We will do a part 2, because once we've acquired the property, we've talked about kind of ways in which to acquire the property. If you have additional questions, Channing is in the group. So Channing Jones, Channing Jones.
Like Channing Tatum.
So she's in the group. So feel free to message her and reach out in that way. And then her contact information is listed also. But definitely we'll have a part 2, because once you acquire the property, we got to worry about getting tenants and maintenance and all those kind of things as well. So we'll definitely do a part 2 as well. So as we're getting our final questions, any closing remarks, Shannon?
I would simply say, the most important thing is I could not have done this without the grace of God. Everything that I do today, I owe to him. The fact that I'm sitting here at home, chilling, doing nothing all day. Now, if I want to do something, I can, but sometimes I don't feel like it. Sometimes I don't want to go out because of COVID. Okay. So just the very fact that what I've done, that one decision has really set me up. I'm so blessed for the rest of my life. So blessed. So that would be my closing comment. And just simply, you can do this. You can do it. Run the numbers. Let that positive cash flow carry you. You can do it. You can do it. That's all. That's all I have to say.
And in closing, I'm going to add, yes, you can do it. Don't just look at the hard numbers, look at the cash flow, but also remember that we have a place on the Eureka platform as well. We'll drop the link in there. And so you can join us over there. One of the great things is the community. And so oftentimes people will say, well, how did you find that out? How did you get that information? Who's available and so forth? And the biggest thing is to have resources, have people that have been vetted, that understand. And I always say, don't just simply listen to random Facebook advice. Oftentimes I'll read like random posts and I'm like, yeah, that person clearly doesn't know. So on the Eureka platform, there is a number of professionals that can also help in terms of being mentors, provide information. There are people that are providing free time. I'm gonna say that twice, free time. So that might be CPAs, attorneys, fellow business owners, and so forth, that you might ordinarily have to actually pay for their time. And they are donating that time through the Eureka platform. So we want to make sure that we're taking advantage of all the resources that sit out there and are readily available. So we'll always make sure that you have the link so you can join us over on the Eureka side as well. Take advantage of, once again, free resources. So to make sure that you understand that and you have that as well. So we'll make sure that we share that. I'll be sharing something actually through Eureka on the retirement platform or the retirement services that are available for our small business owners later on this week. So I'll share that with you all right after we share it with a number of people later on this week as well. So I don't see any other questions. Let me check one more time.
Thanks, you guys, for hanging in there with me and all the math. And but I think it's important for you to see the numbers so you can understand the cash flow.
So perfect. Once again, thank you. And we will see you on next week.
See you guys later. If you have anything, need anything, just reach out.